when you have a clear, concise mental picture of what you want to achieve and a burning desire to achieve it, Napoleon Hill wrote that in Think and Grow Rich. It really is true when it comes to wealth management that you're able to accelerate your impact not only on your wealth, but also in every area of your life.
You're listening to the Millionaires Unveiled podcast, where you'll hear the stories and interviews of everyday millionaires. We'll unveil their decisions, their strategies, and their current portfolio allocation. Now to your hosts, Clark Sheffield and Jace Mattinson.
Welcome back to another episode of the Millionaires Unveiled podcast. This is episode number 166. Clark, how's it going? What's going on in your world?
Nothing much, man. Merry Christmas. Happy Hanukkah. Happy New Year's. Happy holidays. I mean, everything, right?
Yeah, dude, right. We're right in the middle of the holidays. It's great. Y'all do anything fun or you got any traditions?
Yeah, just able to see some family. You guys took a little trip, huh?
Yeah. We are about to be heading here on a trip here. Just actually, I think this will be releasing when we're on our trip. So yeah, it'll be great.
Yeah, I could ask you how it was, but since we're recording it, and we did that last year, I think we were like, oh, how was your trip? Oh, we went skiing. It's kind of hard to talk about what you're going to be doing a week and a half in the future if you don't know for sure.
Yeah, it's totally true. Which brings me to our topic today. We started this year, the Dow rose quite significantly, and we're closing out the year on quite the bull run. Just keeps it continuing. Obviously, we had a little bit of a hiccup mid-year with coronavirus and uncertainty around that. And I think there's still a lot of uncertainty, but nonetheless, the market's up. Real estate seems to be rocking and rolling in most places where it keeps saying this every year, where there's a record low interest rates. And, it doesn't really seem that we're going to have a lot of change here going into 2021. Obviously, we'll have a new, changeover of the guard and the presidency and whatnot. But for the most part, the fundamentals in a lot of places are there, except for our national debt just keeps continuing to grow. We keep continuing to put money into the market, right?
Yeah. Who knows the significance of that anymore? That maybe seems like a silly comment. Of course, it's significant, but we've been talking about this for who knows how many years. Mm-hmm. And every year it just keeps going up and up and up, and nothing seems to change. So I have no sense of how that gets figured out. The interesting thing is when the November 7th election was coming up, it was a big, I thought, and I think others thought, like, oh, if Biden wins, the market's going to drop because Trump's done all these tax plans and all this and that. And he's been so gung-ho about 401k investments, right? He's always tweeting about that nonsense. So, but you haven't seen that. The market's gone up since the election. So that didn't seem to be the case.
Yeah, I think there's a couple of things at play. One, I think we're gaining momentum, obviously, with the vaccine here with coronavirus. I think the other thing is a lot of the market fundamentals are there. Obviously the Fed pumped in a ton of money. It's crazy though, right? Like you hear about all these people losing jobs, but I also drive around and just even my own companies, I'm trying to hire like crazy. I can't find people to hire. So you hear about all these people losing jobs, but then everywhere I drive and in my own businesses, I'm trying to hire constantly. So there's a lot of interesting things on the macro and the micro level, that play into that. Typically, the market, if you look at the history, it responds well when there's not one party or one agenda that controls, all three major branches of the government. And I think that's where the market is essentially trying to price in some of that right now, where they don't think that there will be a sweep, at least in the Senate, and that the Republicans will hold control of the Senate. Now, that's to be determined still, but I think the market's priced in that because I think there would be some adjustment of some uncertainty. If one, they thought he was going to do a lot of things that are on his agenda, or if two, if he had the votes to, between the Senate and the House to really make it all happen.
Yeah, just so many moving pieces. I think it's hard to look at. It'll be an interesting year. 2021 will be an interesting year, and hopefully, realistically, by when? Summer? Maybe end of the year, everything's really gone out, full vaccination, but hopefully things start getting a little bit more normal and back on track, and it'll be interesting to see where we go. You mentioned the long bull market, and who knows how much longer it really lasts. We had a bit, obviously, of a pullback in March, but 8 months, not much of a pullback, really.
No.
Or less than that, 3 or 4 months until it was back, right?
Yeah. What are you big things you're trying to accomplish here, in your personal investment life, or do you have any of that all figured out yet here?
Going forward for 2021, you're saying?
Yeah.
Yeah, one goal I have, just candidly, is I'd like to buy a rental property, a single family home probably. So we've had a few people come on that talk about using turnkey properties, whether that's in Memphis or Ohio or Alabama, Arkansas. I think those are the states that have been mentioned. I've also looked at buying one in Texas, maybe one up by you. So, that's one goal I have for the upcoming year, and hopefully that pans out.
Why have you chosen single family rental?
I kind of want to just try it. I think if you can get $400 or $500 in cash flow, and I think if you buy a $100,000 house, it's cheap to get in. It's a question we ask all the time is, why do you have all these single families? Why don't you just scale up? Well, the answer is somebody doesn't have $400,000 to put in right away to scale up. So I think part of me wants to dabble. I think part of it is just for fun. I want to try it out, see how it goes, see what my experiences is. And I think a lot of the times, if you get a low-end single-family rental, you can get a higher cash-on-cash return.
Yeah, it depends.
You don't have to wait to find a good deal necessarily. So I don't like sitting on tons of cash, but I don't also want to spend the cash just to spend the cash. So if you find a good opportunity, I think it's worth taking, regardless of the investment in a sense. I mean, you could always hire a property management company and make it less of a headache, and that's probably the route I go, just because I'm in New York. I mean, I'm not going to go buy a single family rental on Fifth Avenue.
Yeah, totally. It's good stuff, man. I'm in a little bit in the same boat, looking for some opportunities, obviously for our investors, on the multifamily and commercial side, and getting into some other stuff and potentially trying to acquire another business or two or something. For 2021. It's going to be an interesting year, I think, just in general in the markets. And obviously, I've shared this on the show that I just don't put in very much more into those investments anymore. Just kind of letting them ride. So it's going to be a good year. And, my strategy has not changed at all going into 2021. In fact, I'm probably more aggressive, on the real estate and business side.
Yeah, and it's certainly something we want to do. Find another couple great deals this year and send it out to potential investors here on the show that are interested. So we'll look at that, and those of you that have reached out will continue to send those opportunities as they come. And if somebody else, if you're interested in syndicated real estate opportunities, you're an accredited investor, feel free to reach out to us. Our email is millionairesunveiled@gmail.com, and we'll keep you posted on any opportunities that we get.
Last week, we had Daniel. He had a net worth of $10 million and the founder of the newsletter Future Money Trains. He has a broad list of investments and definitely has one of the higher net worths of millionaires that we've had on the show. So great interview with him. He's definitely more of an entrepreneur, an entrepreneurial mindset. Today, we have Jonathan. He works as a financial advisor. We discuss his career and journey as a financial advisor and when it makes sense to have one as part of your team. Appreciate y'all tuning into the podcast week after week. If you enjoy the show, we'd appreciate leaving a 5-star review in either iTunes or Stitcher. Really helps us continue to grow the show and reach new millionaire interviewees. And just for our listeners going into 2021, we have some phenomenal interviews coming up, some of the ones I'm most excited for. We've got another plumber coming up. We've got all sorts of, everyday millionaires from all over the world, all over the United States, all sorts of different investment allocations. So it's going to be a great, great, great year, 2021. I'm really looking forward to what we have in store for the show and our new website. And we've got a course coming out and all sorts of interesting and awesome things for our listeners and our following. We appreciate y'all. And really, this show would not be what it is without y'all. So we appreciate that. Without any further delay, let's get the episode with Jonathan. Jonathan, do you want to just give us a little about your background and kind of what you do now?
Yeah, thanks, Clark. I'd be happy to. So I am the CEO, and I should say steward, of Lionsgate Advisors. It's a wealth management firm based out of St. Louis. And my wife and I have been married for a little over 7 years. It'll be 8 years this summer. We're expecting our third. We have a 3.5-year-old and a 2-year-old at this time. And we're just growing a family and growing our business and serving families to accelerate the impact of their wealth.
Awesome. And we're going to get a little bit into what you do and stuff, but kind of, do you want to just paint a picture for our audience, kind of where you've come from and how you got into what you're doing today?
Yeah, thanks. It started off right out of high school. I was in Russia with my parents back in 93 through 96. And so I'm a little bit older than you guys, but what happened was I was asked to be a tour guide for a group of Americans that had come to visit St. Petersburg and to give them a tour of St. Petersburg and Moscow. And I witnessed a gentleman that was very generous with his giving. And I was so amazed by the impact he had in people's lives. I went up to him afterwards and I said, "What is it that you do? Because I want to do it. I haven't seen anybody else that's come here in a 3-year time frame and given as generously as you have, made the impact in people's lives." And he would literally had a wad of $100 bills that it was, had a rubber band around in his pocket that at the end of meeting with somebody, if he had felt prompted to, he would give them that as a blessing. And I just was amazed by his generosity and was compelled that one day I would want to be in a business that afforded me the opportunity to do the same thing. And it wasn't until 2 years ago, about this time, that I actually ran into him again. And that was, it had been over 24 years that I'd met him. And we met in Lisbon, Portugal, when I was on vacation. You don't remember me, but I was a young man that gave you a tour in St. Petersburg and Moscow. And just the impact he had alone in my life really helped me get to where I'm at today, to paint the trajectory of being in wealth management and finance.
Wow, that's pretty crazy. So what, was he a financial advisor?
Yeah, I had no clue. He told me he did international finance, and come to find out, he's one of the lead life insurance agents for billionaires here in the nation.
Let me just circle back, Jonathan, on your history a little bit. When did you become a financial advisor? Is that what you always did? Did you have a career in something else?
I started off my senior year of college doing an internship with Primerica, which was the marketing division of Citigroup. And so right away, I had a desire to do international business because of my experience in Russia. And graduating from college, I thought I'd want to work with a financial firm since that was Richard's impact of where he had worked and kind of the influence that he had had. And so I thought that would be a good career path, and worked my way up really through finance in one form or another, whether it was in the broker-dealer side, working with a wirehouse through Citi, or actually going through and starting my own firm and being able to identify how to become an independent, really be taking on a fiduciary role. So there's been different forms of the roles I've taken over the years, but for the past close to 20 years now, this has been where I focused on and devoted my life to.
Okay, awesome. And just for our listeners, we wanted to bring Jonathan on the show because often the question that we ask to each of the interviewees, whether millionaire or close to becoming a millionaire, is have you used a financial advisor? Right. And many of them have, and many of them have not. And so we just thought it would be fun. Occasionally we like to bring on a guest in the financial space and talk about some of these things. So that's why Jonathan's on today. So let me ask this, Jonathan, first. Who in your eyes should use and pay a financial advisor?
Great question. It'd be kind of like asking a professional athlete, do you need a coach, and what purpose or value does he bring? So anytime you're wanting to achieve success, I think you need a coach in your life that's going to help you be able to see things that you don't see and help you get to a place that you can't get to on your own. And so for each person, that could be answered differently, right? Someone may have had great fundamentals that they learned from an early age on how to be able to be frugal with what they had, how to be able to invest. I know that I started when I was in sixth grade, learning how to be able to invest in the stock market and understanding that, and was always intrigued by it, but didn't really get into it until college. But had the fundamentals to understand, hey, it's good to be out of debt. You got to build up an emergency fund, and just the books that I was encouraged to read throughout. And also it helped with my own experience of having to become an Eagle Scout when I was 16, of setting goals and being able to learn about personal finance. My experience was drastically different than someone that never had that imprinting early on in their life, as I know you guys have had as well. So when I think about who needs a financial advisor, I really look for the level of sophistication of what are their goals, and do they have clarity around the purpose of what they want to achieve, and do they need someone to help get to the next level? And for a lot of our clients, we find about 50% of them have had a financial advisor, and another 50% have not. But they get to a point they're saying, I need someone that can help me identify tax strategies to convert my tax liability of what I owe my favorite uncle, and be able to convert that into an income-producing asset or a tax-free investment strategy. Depending on the level of sophistication or the size, really varies, but it's all around what the next step or next goal for that individual or family is.
Okay, so you say tax-free retirement, revenue streams, and how to kind of minimize taxes, right? What are some of the strategies you work with your clients on in that regard?
And David McKnight wrote a book called The Power of Zero, he had interviewed the former Comptroller General of the U.S. His name was David Walker, about what is ahead of us in the economy, and understanding that there's a tsunami of debt that our country has, and we continue to add to that with every additional bailout or quantitative easing or stimulus package, that it will force our country to have to raise interest rates. Not only interest rates, but also taxes at some point. And historically, the historical highs for taxes have been as high as 90%. If you remember President Ronald Reagan, he had been an actor in the past, and he had at one point, living in California, he would only produce 2 films a year because the highest marginal income tax bracket was 90%. And if you made over $200,000 a year, then 90% would go to federal, 8% state. So he'd only make 2 cents on every dollar. So he would only make two films a year and only paid $100,000 per film for that reason. So when we think of most of the families we've sat down with have created their wealth via tax-deferred investments and in taxable accounts, they've set up where they're having to continue to pay taxes each year on the taxable accounts, meaning their brokerage accounts or their bank accounts, or they've had to defer it until sometime in the future of paying those taxes, and they've received a deduction if they funded their 401k or their IRA. So if you were to think the tax situation in the future, Clark and Jason, would you guys agree that the taxes will most likely increase in the future? Or do you think
I'd agree with that.
So, if we're looking at taxes being at a relative discount in comparison to what they could be in the future, we have to look at tax strategies to look at how do we convert those IRAs or 401ks or tax-deferred accounts now into a Roth, or understand what are the 3 tax codes that allow for it to grow tax-exempt or tax-free. How do you move it to that bucket? And there's really 3. One is the Roth that I've already mentioned that came out in 1993. The other is taking a look at munis or municipal bonds, which aren't really that appealing. And the third is life insurance, and that's talking around IRS tax code 7702. And what is interesting is that I would venture to guess 90 to 95% of all the policies that are set up for life insurance are not designed around that tax code. They're designed about what makes the most commissions for an insurance agent or what is actually most profitable for the insurance company. And so the industry has really received a bad rap. But when you're working with a fiduciary that is in tune with understanding tax strategies and has built that at an institutional or wholesale product of being able to engineer it for the best use as a fiduciary for the clients, that's where you can start to transfer those assets after paying taxes on them into an account that can oftentimes have double-digit internal rates of return and a significantly high withdrawal rates when you need to have access to it. So those are the 3 different areas that we find, and typically you need to pair any type of conversion or any income that you have. So if you have high income earners that are not quite yet rich, we call them Henrys. So you need to be able to understand what are some of the tax credits and tax strategies to be able to get that you can leverage to be able to reduce what you owe to Uncle Sam. And I'm not talking about tax evasion. I'm talking about there's really two different tax codes in the world, those for the informed and those for the uninformed. And it's each person's liberty to be able to determine, I think it was Judge Leonard Hand who actually came up with that quote. Each person can be able to make a decision on do they want to be proactive about it and work with a team that can help them navigate that transition while we have this window currently. And I think we've got a window at least until right now, unless it changes, where the current tax reform won't sunset until 2026.
Gotcha. So I want to go back to kind of, you said a bad look for the industry. On financial advisors, sometimes they do get a bad rap, right? Yeah. And it's either from what people hear, right, or from their own experience. So I'm just curious why you think it is, and obviously you're trying to build it back the other way, but why do you think financial advisors get a bad rap?
Well, I think the industry in itself is set up to be able to have broker-dealers or advisors work for companies that have products that are sold based off the profitability for the company rather than what's in the best interest of the consumer or the individual. So historically, that's been very true. And, the DOL and the SEC are really working on creating this Reg BI which is the regulatory best interest for everyone to have to use. RIAs, registered investment advisors, have always been fiduciaries who could not earn a commission on investment assets, whereas a broker dealer, someone that was a registered representative, anyone that was working at a brokerage house or wirehouse like your main box companies, they're all paid a commission on what they sell. And so that's why there's really been a bad rep, is that they have an incentive to sell a product rather than create uncorrelated investment strategies to help families accumulate wealth. But most of the wealth that we're seeing being created is not created via mutual funds and indices. It's from investments in real estate, investment in businesses, pink slips for venture capital, or from those investments or stocks that they held on from early stage investing that appreciated over time.
Yeah. So, Jonathan, do you advise people on those other asset classes, or do you stick primarily to what you described in those three buckets before?
Well, the three buckets really comprise any type of asset class. So, whether it's taxable or tax deferred or tax exempt, any of the investments you guys are aware of can be in any one of those. And that would be true for anyone in the U.S. The difference being is that most of the time, the families are unaware of them because it's not publicly taught and it's not widely accepted among financial advisors. Financial advisors stick to what they know. They may say mutual funds or stocks or bonds. Maybe some guys do insurance, but most of the guys that do insurance are just insurance agents. Most of the guys that do investments are just that. And they haven't done what it takes to be able to become a true expert on how to look holistically, and that's why I use that term financially, for how can they use uncorrelated investment strategies for the best use for the families or individuals. And it's simply, why do you have some guys that make it to the NFL and others don't? Some guys have the desire to be able to become the best at what they can be and learn, be the best at the craft. And there's not to belittle people that are focused on mutual funds or investments with their licenses. They just haven't stretched themselves to be able to be the best in all areas.
So, Jonathan, let's switch gears here a little bit. What are some of your clients worried about right now, and what are some things that they're coming to you? And given the environment that we're in, we're recording this mid-April. We've got global pandemic going on. Many states, including the state that I'm in Texas, is looking at reopening the economy. But we've got 20 million people that are without jobs right now.
Right. And I guess what was the question again?
What are some of your clients coming to you asking about right now? I mean, we've seen a massive hit in the market, from highs in January, February. What are they concerned about now, and what are they coming to y'all and asking about?
That's a good question. So, Jace, we had seen this coming. We knew it was going to happen at some point. So, for the past several years, we've been diversifying our clients using uncorrelated investment strategies, so that a very small amount of their overall investments were impacted by the market correction that we saw happen in March, and that are currently impacted now, even as we see the COVID crisis can persist. So one of the differences is, and the reason why I say that, Jason, is because we've taken an approach of benchmarking our clients' purpose and their goals. And when you have clear alignment and collectively understood goals, and really have an understanding of what that means to you, and what does that mean for your family, and where do you derive meaning from that, then you're able to create strategies or be able to get advice that helps achieve those goals and that purpose, and then document that, and then have a plan to get advice that's in relation to what you want to achieve. And when you're able to document that, or you have an advisor that's able to quarterback that understand the clarity of that purpose, and then develop that plan, and make sure that the other trusted advisors on the team, whether it's the CPAs or the state attorneys, come together collectively to build out better recommendations, it elevates the level of service and advice that you get. And so for our clients, there's only been a couple people that we've had to walk back off the edge that were wanting to sell everything and just kind of not walk away, but put it all in cash because they're so uncertain. But most of I should say all of our clients for that matter, have really wanted to hear more from us about what's happening in the economy. What are we doing as far as, are we looking at other additional uncorrelated assets to be able to bring onto our platform? And those have really been great conversations to have. And it's really given us additional opportunity to take advantage of these. I believe it will be a prolonged downturn in the market. It's not going to just be this V-shaped bounce. But those are some of the things that we're seeing our clients are interested in, most of which because we've been working closely together for either weeks, months, or years to be able to help them develop plans so they wouldn't be significantly impacted or derailed from their life pursuit or their purpose that they had for their money.
Sure. So should people be putting money into the market right now, do you think?
You know what? I think that between now and 2022, we're going to probably see some of the greatest opportunity for wealth generation in our country. And that's simply because I don't think the market's at the peak economically. There's a lot still, once you have an excess of debt, there's got to be a kind of I want to call the system has to kind of blow off the excess debt and come back to a normalization of prices, the PE ratios for the firms. And right now we've had it's overinflated and continues to be, while some come in alignment and present great opportunities. It's just amazing. We're finding that some of our dividend strategies, we've got our dividend portfolio currently, even though there's been so many layoffs and so many people that are not receiving income, we're still hitting double-digit dividend yield on a quarterly basis. And so throughout a year, I should say, it's averaging out to a double-digit dividend, where they're just able to use that to repurchase additional assets or shares of those underlying holdings. So, when you're attuned to that, you can create a lot of wealth, whether it's using active or adaptive strategies. And I absolutely believe that over this next 2 or 3 years, we're going to see a great opportunity for those that have been on the sidelines that are just starting to get into, hey, I want to wait till the market comes down. You really need a dollar cost average into this market and be able to say, okay, I'm just going to have a plan to consistently buy in, whether the market's up or down, because it's going to be pretty volatile. And you'll have some great opportunities to create wealth for yourself if you do so.
Yeah, that's what we're seeing now, right? Huge swings, at least this week, big swings every day for the most part, up and down, right?
Yeah.
So on the dividend side, do you think, though, that a lot of these companies, I mean, it's already been announced, right? Some of them are starting to stop pay the dividends or certainly pay less.
Yeah, that's absolutely true. That's the majority of them, by the way.
Yeah. So you talked about kind of getting a clear picture on investments and then being able to help people get to where they want to go. What if somebody doesn't know that? Right? What if somebody comes to you and says, look, I'm making X amount of money, I can save Y amount, whatever, and I don't know what to do. Right? I've heard it's important. I want to take a little bit of control, but I don't know the direction. At that point, what's the conversation? Is it just finding out their risk appetite and seeing whether they're interested in something like real estate or something else? Or what's kind of your answer to somebody who may approach you with that type of question?
Well, I'd like to come back, Clark, and be able to ask a few more clarifying questions. I know we've all heard the question, what keeps you up at night? But rather than asking that question, I'd rather ask, well, what's most meaningful for them? Is it quality of life? Are they looking for deeper relationships? Are they looking for more peace of mind? And how would they quantify it? And they may not be able to quantify it. Or we've had some clients come to us say, I really wanted to be able to make sure I could have a vacation for, at least a couple times a year for a week at a time with my family. I want to continue to do that while we're accumulating wealth or saving for retirement. Okay, I just got clarity on two things. One, they do want to save for retirement. And the other is they want to be sure to have their vacations with the family because that quality time is important. Others have come saying, I've got a tremendous amount that I owe the IRS each year, but I'd rather give more away to charities. How can I do that more efficiently and still be able to save for retirement and make an impact in the communities that I really feel strongly about? So for each person, there's a different answer to that. Wealth managers are traditionally, it's like they've all gone through and by the way, we're considered kind of an advisor's advisor. So I'm not trying to beat up traditional wealth management. By no means am I trying to encompass every advisor you've ever met. It's just, I'm speaking in blanket terms for the industry, most of which all have a regulation because of the SEC to ask the questions about your risk tolerance and what you're willing to be able to participate in downside risk and upside potential. And most of our clients have never come to us saying, hey, I want to be able to give you a letter that I sign off and allow you to lose me 40% and with the potential to make upside. They've come through and said, I would rather you not lose anything and make as much as possible, right? And so that's not always going to be possible. And so that's why there's the risk tolerance questionnaire, and then you're kind of pigeonholed into a risk profile, if you will. That's not always in alignment for what you want to achieve or the purpose. And so when we see there's a disconnect between someone's risk preference and their goals, we have to start thinking outside the box for what other asset classes, whether it's real estate or whether it's taking a look at the stock market or just looking at insurance products, of what's the best combination of those strategies to be able to help them achieve their risk preference, but really make sure that what we're benchmarking isn't whether or not they're conservative or aggressive, but are they on track to accomplish their goal? And we spend a lot more time around that, because when you have a clear, concise mental picture of what you want to achieve and a burning desire to achieve it, Napoleon Hill wrote that in Think and Grow Rich. It really is true when it comes to wealth management that you're able to accelerate your impact not only in your wealth, but also in every area of your life.
No, I like that. I think it's a good answer, having a little bit of clarity about what you want and helping get there, right, with the risk in mind. So I just want to shift gears here. And I know you guys probably do a little bit of this, right? Like dealing with estate attorneys and wills and that sort of stuff. When should somebody make a will? I mean, obviously, I think the answer is going to be right away, right? Yep. But when should that all be in line? Should Jace, who's 32 years old with 2 kids, should he have an estate attorney right now and a will and a financial advisor? Should he have that all lined up at a young age, or is it easier to just have a will and say that's okay for now?
You know, it's great you asked that question. It was one that struck me when I was right out of college, because my dad said to me, and at the time I was living in Colorado, where my family still is, and I was climbing 14ers every weekend. I've climbed 27 of the 53 or 54, arguably, 14ers in Colorado, and some of them many times over. And my dad came to me and said, well, son, have you ever thought about what happens if you get hurt on the mountain? I said, well, no, not really. And he said, what if you die? I said, I haven't ever thought about dying. And he said, well, that may be something for you to think about, because if you don't have any insurance, that could possibly bankrupt your mom and I. And I thought, I had never considered how it could impact someone else. Or, if they had to fly my body off of a mountain or have a team go up and drag me off, whatever it may be. And I've carried people off the mountain before. But I hadn't thought about the impact it would have. So when you start to look past yourself and you have a self-awareness and also how it may impose on others, trying to sort through what you have or your personal effect, then that's when you need to get a will. And I would say that's probably as early as when you become age of majority. But when it comes to determining if you want to have an estate plan versus a will, that's really up to the individual. I guess the question I'd have for you, if the difference between a will and having a trust is that if you have a will, everyone in the world gets to know about what you did or didn't do. I mean, it becomes public information. But if you have an estate plan and a trust, then you can keep that private and confidential only to the beneficiaries that you were the grantor for.
Interesting. So talk a little bit more about that. That's kind of new to me. So what do you mean it becomes totally public?
Oh, it's like, I don't know if you're aware, but it becomes a public information at that point of what wealth that you had, the properties that you held, how much wealth that you'd accumulated, and where it's going. So that's how come we get so much information from. I'm trying to think of who some of the biggest people were, but the Michael Jackson estate and some of the other major actors and actresses that died without having a will or having a estate plan. They may have had a will, but it was all public information that anyone could look up and oftentimes publicize. When it's an estate plan with a trust, it's registered with the state or with the courthouse, so that it stays private, and all your personal information is only released to the beneficiaries of the trust who are outlined in the trust. The information that they receive is a copy of the trust for who's getting what and how that's going to be dispersed. But otherwise, it's public.
Okay, interesting. So Just totally changing gears here, Jonathan. I was just kind of thinking about this as you were answering that. What would be I'm going to call it your order of operations to invest, right? So if somebody has money and they have a job, right? They make, let's just call it 60 grand. Where should they start investing? I would think the first step would be through their matched 401k at work, right? After that, because it's free money, right? After that, where would you say? Is it a Roth IRA? Is it an HSA? Is it a 529? Is it something else? I mean, where does somebody, I'm just trying to think for the person who's starting out here, right? Where should they kind of prioritize their investments?
Yeah, and Clark, looking at how to prioritize, to speak further into the 401k, I would never invest into tax-deferred accounts. So I know it's going to come as a shock, but let me clarify. If I believe that taxes are going to go up and it could potentially increase or double in my lifetime, would I rather pay taxes on the seed or the harvest?
Right. I'm with you there.
So if I'm going to pay taxes on the seed, then I'm willing to go ahead in my 401k to invest my contributions into the 401k Roth. If I'm limited to a 401k Roth and then I want to maximize the 401k, one unknown fact for a lot of people is that any excess contribution you make to your 401k above the limit each year is now after-tax contributions into your 401k, which can later be rolled into a Roth, even if you make more than's permissible for Roth contributions.
Right.
So the reason when we look at a Roth, if it's available and you want to be in the stock market, a Roth IRA can make a lot of sense for where you invest your after-tax dollars outside of your work 401k, because you can have more discretion over where it's positioned or how it's invested.
Sure.
The other alternative is to use, I got to say this with some discretion, about 90 to 95% of insurance policies that we find in the market are not sold to this design that I'm about to speak to. But if you have a life insurance policy that's a wholesale policy that's institutional grade, it can really become an investment grade life insurance policy where the internal costs over a 20-year period average out to about 1.5%, which is typical of what you may find with a mutual fund or ETFs over time, even in the 401k. When we're looking at after-tax dollars, or where to put it, a life insurance policy that's structured that way can make a lot of sense because it really becomes a rich man's Roth. Now, what's interesting is that when I compare a Roth and a life insurance policy structured in the manner I've just discussed, the tax code for the Roth IRA was really taken from looking at how those 7702 accounts were set up with the restrictions around them for the life insurance, meaning that for a Roth, you had to have a Roth IRA for at least 5 years before you could withdraw the principal. Let me rephrase. Before you could withdraw the interest. Now, if you're under 59 and a half, you're penalized, with the exception of this year, by 10% for the withdrawal that you've made from your Roth or from your IRA or 401k. And I say with the exception of this year for 2020 because the CARES Act gave a one-time an exception for this year for a certain percentage. But when we think about long-term for the investing, the life insurance tax code was originally written that you had to be able to fund the policy for at least a 5-year time frame. So that, and the ideal was that there was a 7-year limit of how much you could overfund the policy. Back in the early 80s, life insurance policies didn't have these restrictions prior to the 1980s. And so the Rockefellers, the Kennedys, each of these family, even Disney, funded his first theme park from using the cash value of a life insurance policy because at the time there wasn't a restriction to how much you could overfund. It'd be like having a Roth IRA that you could overfund the amount that you put into the account, allow it to go tax-free, and then or tax-deferred, and if structured correctly, be able to receive it tax-free. And they were able to do that through the form of positive arbitrage from the loan of the insurance carrier while allowing the money to continue to sit there and have a dividend at growth. Well, that's kind of a complex structure, but when you think of it, banks wouldn't lend to him. He was able to use that money and build his first theme park. Other families that I mentioned have been able to pass on generationally tax-free estate to that's continued to grow year after year. That's all available to the American people. It's just that the industry has gotten a bad rep, and so because the industry hasn't been teaching families how to design it for themselves and hasn't taught advisors how to do that either. So when we think about what I'm talking through, if you could access your money at any time that you had an emergency between the day one and later in life for retirement, you would want to have access to that without penalty, without being able to pay taxes on it, and to allow it to continue to grow and have a positive arbitrage. That's how life insurance was originally designed, and the death benefit of life insurance was secondary in nature. The policies that are designed today typically aren't designed to maximize the efficiencies of that contract, and most advisors aren't trained on how to do that. So when we look at really implementing that into an overall income or a cash flow strategy, if you're able to accumulate cash that you can have access that can still get index returns and participate in gains in the market with having a floor of 0, that can really help you mitigate losses in the market like we've just seen here in earlier 2020.
Awesome. So Jonathan, just wrapping up here, tell us a little bit more about Lionsgate Advisors, where people can find you and get in touch with you.
Well, great question. Thank you so much, Clark. So the sole purpose of Lionsgate Advisors is to accelerate the impact of our clients' wealth and enabling them to improve the use and enjoyment and impact of their family's assets to build greater prosperity for a greater purpose. And you can be able to visit our website. For any of you that are business owners, we have a free complimentary evaluation of your firm, of your business that we offer. You go to lionsgateadvisors.com, and on our front site on the first screen there, you'll see a business evaluation tool that's complimentary if you want to take that and help identify what's the current asset of your business. And for those of you that aren't business owners yet, it's always a great time to start. But typically when we see the markets are down and make a correction is when we see a new growth and injection of entrepreneurs that are getting started with their business. They need a place to how to benchmark it and how to evaluate what they've done so far or what they will do in the future. And that's where you can reach us, is going to our website, lionsgateadvisors.com. It's Lionsgate like the entertainment company, and then Advisors, with ORS.
Awesome. Well, thanks, Jonathan, for coming on. Really appreciate that, everybody. That's Jonathan from Lionsgate Advisors, financial advisor. Thank you so much for coming on. Really appreciate your time.
Clark, Chase, thank you very much.
Thanks, Jonathan.
Thanks for listening to the Millionaires Unveiled podcast with Clark Sheffield and Chase Mattinson. For more stories, investment opportunities, and information, check out our website at millionairesunveiled.com. See you next time when you'll hear from another everyday millionaire.